Well, welcome back, everyone. Nice little morning discussion on insurance and how we reported on income tax returns. We're going to change gears here a little bit and talk about state tax issues. Just wanted to kind of start off with a filing requirement reminder of what we're looking at for the Commonwealth of Pennsylvania. And even though we had already addressed this in the income section, do want to kind of remind you what Lancaster County would look like as well. The main reason is that the local return system mirrors much more of the state system than it does the federal. Both of these are not going to be found in the 4012 or other IRS material, but they are found in your volunteer guide on how to prepare state and local returns. So one issue we have with Pennsylvania is Pennsylvania is going to require a return to be filed in 2018 if you have $33 of income. So no $12,000 standard deduction, $24,000, or add a couple thousand on there if you're over 65 and blind. 33 is the threshold. The reason why is Pennsylvania has a nice tax rate to calculate, 3.07%. Flat tax, irrespective of the amount of income that you have. Now, they must have gone to the IRS school to figure out that let's just use numbers that are a little off. 8.05%, 3.07%. Let's just try and get somewhere close there. But we're looking at 3.07% flat tax. There is a requirement that anyone over $33 of income would need to file a return. Minors are not excluded. So technically, if an individual at the age of 8 has interest income and dividend income, because their grandparent thought it would be kind of nice to give them a couple shares of Disney stock as a gift, technically, that would be subject to Pennsylvania personal income tax, and the child would need to file a return. Just as a caution, once the child files a return, the Commonwealth of Pennsylvania will be looking for a return every year from them once they're in their system. So for a minor, there's no exception for filing. Again, $33 would be our income threshold. So we may see that quite a bit here in terms of individuals who may not have a filing requirement for federal, but would for PA. Now, we'll be talking about a couple reasons why they may not need to pay tax, but they would still have a filing requirement. One other issue that would be requiring a filing would be if they have a loss from a business that would include a self-employment business or a pass-through from a partnership or S corporation. Ironically, Pennsylvania won't allow you to deduct the loss, but they will make you file a return if you have one. So if you do have a loss from a sole proprietorship, partnership, or S corporation, they would like you to file. For Lancaster County, just kind of emphasizing that again, that is only based on earned income. So it's only going to be earned income tax. So wages, active partnership activity, anything like we'd have from a self-employment business. So wages, self-employment, active partnership would be considered earned income. That's for all of Lancaster County and part of the Octorara School District as well. So they cover that region. Now, this does have a threshold. You have to be over 16 to 16 and older to be able to file a local return. So if you're under 16, there's no filing requirement. Which again, kind of going back to the Amish, when those kids are working on the farm from 12 to 15, they're in good shape. Once they hit 16, now they're filing a local return. So just something to watch out. If you're under 16, you don't need to file a local return. Once you hit 16, you will be part of that filing mechanism. Another reminder, if you're preparing a return and the taxpayer has received a blank form from Lancaster County with their name on it, Lancaster County expects that to be filled out and sent back, even if they have no income. So if they have no income, check off the reason why there's no income, retired, homemaker, deceased, and send that back. I've been checking deceased now for the past 7 years. They keep sending me one. Apparently they don't believe it. So they will eventually take you off the rolls if they get the correct information, hopefully. They must be checking the obits and haven't seen me yet. So I still keep getting one. But all joking aside, if you do get one, be sure to send it back in for the client. Otherwise, they make it a non-filing notice later in the year, which could be a $25 per person penalty. So we don't want them to inadvertently have a $50 charge because they and their spouse did not file a local return. So if they do get one, be sure to check the box why there's no earned income and send it back to local county. All right, but getting more so into Pennsylvania taxes. Pennsylvania has a unique taxing system, to put it mildly. If you thought the federal was slightly confusing, wait till we see PA. PA has a structure where they're one of the first areas to have a flat tax, which sounds kind of nice, right? It's a pretty easy. We don't have to worry about graduated rates. There's no real differences in filing status. In fact, when we talk about PA, you're technically not filing a joint return. The taxpayer and spouse are going to be on the same form, but they're going to be calculated separately. So we'll talk about some offsets that we have. Mainly the reason to file a joint return for PA is for a matter of convenience. One downside for PA, if you file a joint return and there's a liability due, Pennsylvania could go after either party. So just one thing to maybe keep in mind, that you can actually separate the returns for state and local purposes, even if you file jointly for federal. So if people say, hey, I want to file separately, and you remind them, by the way, you may not want to if you want to take certain credits and opportunities, and they say, okay, I'll file jointly. You can still file separately for Pennsylvania and local purposes. So you do have that option as well. But basically what we're going to take a look at, Pennsylvania has 8 different classes of income. So we're going to have those as clear delineation. What's unique about these is that they will add up any positive amounts, but you don't get credit for a negative number in any of these categories. So if you have a business loss, it will not offset interest income like it does on a federal return. Another unique aspect is a loss from a spouse will not offset income from another spouse. So if one spouse has capital losses on their account and the other one has capital gains, we only report the capital gains from that one spouse. So it's kind of a unique scenario. But Pennsylvania uses 8 categories of income. We're going to have wages, we're going to have interest, we're going to have dividends, business income, and gains and loss from the sale of property. Those are traditionally the 5 categories we're going to see within VITA, those first top 5 categories. They will also tax anything from rent and royalties. Typically, these are outside the scope of VITA. Also, estate and trust income, also typically outside the scope of VITA returns. The 8th category is gambling and lottery winnings. A couple years ago, Pennsylvania changed its rules. Now all lottery winnings are taxable in PA. A couple years ago, I gave you the advice, if you wanted to play Powerball or Mega Millions, buy the lottery ticket in PA because it would not be taxed in PA if you bought it in PA. They've changed their rule now to say no matter where you buy the ticket, it's going to be taxable for Pennsylvania purposes. So feel free to buy your lottery ticket wherever you feel like it now. If you go down to the shore and you want to buy a lottery ticket down there with your Grotto's Pizza, that's fine. You can go ahead and do that. No problem where you buy it. It's going to be taxable irrespective of where that ticket is purchased. So those are the 8 categories of income. We'll take a look a little bit deeper at a couple of these areas. A lot of things that people take a look at. Pennsylvania is not a bad state to retire other than the fact it's cold right now. We have a fairly long winter. But if you take a look at surrounding states, Pennsylvania is actually a favorable place to retire. And the reason why is because Pennsylvania does not tax a lot of items of income like they do in New York, New Jersey, and other surrounding states. Pennsylvania does not tax Social Security. They don't tax railroad disability and retirement benefits. They typically don't tax pension distributions or retirement distributions. And you'll see there's a little asterisk up there that we'll talk about in just a minute. They don't tax unemployment compensation. They don't tax sick pay. They don't tax disability or alimony. They also don't tax inheritance or death benefits, and active duty military pay is not taxed either. So there are a lot of items of income that aren't even subject to PA tax. So if you're a retiree, your Social Security is not taxable, your retirement income is not taxable. If you're receiving alimony, that's not taxable for PA either. Now, the exception that we have, we talked a little bit about this during our income section, where if we had a 1099-R with a code 1 in box 7, an early withdrawal from a retirement account, Pennsylvania will treat those amounts as taxable compensation. Because it's coming from an employer type account, if you take an early withdrawal from your retirement account, it will be considered as taxable compensation. So Pennsylvania will be looking at those to be reported on the PA return. Now, the unique aspect about Pennsylvania tax law is when we take a look at W-2s, typically your Pennsylvania wages may be higher than they are for federal taxable purposes. And it's because Pennsylvania does not allow a deduction for contributions to a retirement plan, meaning that when you take a distribution from your retirement plan, part of that is your own taxable dollars coming back. So Pennsylvania will allow you to recover your initial contributions before they tax you on the earnings. The downside, Very few people know what their taxable or what their contributions were. And in the past, we've kind of said, all right, let's just come up with a best guess scenario. Pennsylvania will give you a number. It's 0. We know you did not have 0 contributions. I just recently worked with a client who got a letter from the Department of Revenue where we had taken a reduction of their taxable amount due to contributions. They requested a statement from the third-party administrator showing the amount of contributions to that account. So we're going to have to work with PA on how that's going to work. Obviously, the state does not understand how some of these accounts will move from one to another. So the issuer of the retirement account had no idea how much the basis would be. But we basically have to come up with an opportunity of how we're going to report that. Some suggestions we have: if it's a relatively recent retirement account, you can go back and take a look at their W-2s and find out how much had been contributed. The amount in box D, if they have a W-2, would show how much they contributed to their plan. So what we may see is a situation where a taxpayer may have been employed, left employment, decided to take their money with them. If that's the case, we can take a look at their W-2 for the current year and maybe a few prior, and come up with an amount that we believe is reasonable for their initial contribution. That initial contribution comes back tax-free. It's going to be a recovery of basis. There's a couple little quirks we have to work with in TaxSlayer to get it to work. And we'll see what happens with TaxSlayer's updates, what those new quirks will be for the current year. Good news is we don't see this all that often, but just bear in mind if there is an early withdrawal from a retirement account, it may be partially taxable for PA, which will also become taxable in the same amount for local purposes as well. So we just want to kind of point that out. All right, so kind of continuing on compensation. So we know that early withdrawals from retirement accounts would be considered compensation. However, you do get to recover any of your initial contributions first before the earnings become taxable. Now, what happens with Pennsylvania is we will actually be able to have a schedule that it goes with the electronic filed copy of the return called a W-2S. This is going to be reporting all the compensation the taxpayer has, traditionally following after the PA 40 in terms of its print order. Again, just bear in mind that the Pennsylvania wages may be different from federal. Box 1 for federal will take into account some reductions, things like the employee voluntary contribution to a retirement account. Again, Pennsylvania does not allow that as a deduction, so typically PA wages may be higher. When you go into TaxSlayer, it's automatically going to assume that federal, Medicare, and Social Security are all taxable in the same amount. Once we start overriding it, we'll just enter the W-2 as shown. Pennsylvania will have a presumption that the Medicare wages, so what's showing up in box 5 of the W-2, should be the exact amount that's PA taxable compensation. Sometimes they may be slightly off. We do have an opportunity within TaxSlayer that there is a reconciliation form. Fortunately, I don't think we see it all that often, just to show where PA wages match Medicare. Generally, TaxSlayer will pick up those differences fairly well. But just as a reminder, when you enter the information from a W-2, just take a look at box 16, which would be your PA wages, and enter the appropriate withholding in box 17. Just be sure that when you're entering the local component, we don't actually end up putting any local tax in the state section. Sometimes you'll see a employer put LST information or something else in the state and local lines. Just be sure we're not inadvertently putting those in the wrong categories. Once you put those in, they will flow automatically. Generally not a whole lot of issues with the W-2s. We just need to go ahead and report those as shown, and they will automatically flow over. A couple other things that we take a look at for compensation issues is Pennsylvania actually has a reciprocal agreement with a number of surrounding states. One of the interesting parts, much like we talked about surrounding states, if you think back to when we talked about the definition of qualifying relative, our first definition was someone not even related to us. When I mentioned surrounding states, the first state on this list is Indiana. Now, even if you haven't looked at a map or a chart or some kind of legend, you may know that Indianapolis is not on the other side of the PA border. Indiana is a couple states away. However, we have a reciprocal agreement with them. So this is one of the states on here that does not actually touch Pennsylvania. But if you work in Indiana, you are eligible to have Pennsylvania tax withheld on your Indiana wages. Much like if for some reason someone's commuting daily from Indianapolis to Lancaster County to work, The employer can withhold Indiana income tax, not Pennsylvania. So the reason why we point this out, you may see some unique issues where, particularly here in Lancaster County, I think the state will probably see a little bit more often, maybe Maryland, as employees may have jobs in Maryland. The employer in Maryland should be withholding Pennsylvania tax. Same thing if an employee works in New Jersey. The employer should withhold PA taxes. It's a reciprocal agreement. Now, we don't have these with Delaware, and there is a state to our north that doesn't play well with others. That's New York. They don't reciprocate with anyone. If you work there, they tax you there. If you go there, they tax you there. So we don't have an opportunity. If someone has a New York job, we may have to file multi-state returns, and it gets a little bit unique of how that situation works in VITA. So if we see that, you may want to talk to a site coordinator about what to do with multi-state issues. Part of the other thing we take a look at here with these states, again, they should be withholding Pennsylvania wages if you're in Indiana, Maryland, New Jersey, Ohio, Virginia, or West Virginia. Again, Virginia is kind of a stretch. They don't touch us either, but you can kind of get through some of our reciprocal states to get there. If someone does have state taxes withheld in that state, it becomes a little bit more complex. We actually need to file a state return in that other jurisdiction to get that money back and then pay tax in PA. So if you do see someone and they have a Virginia employer and they're withholding Virginia tax, we need to file a Virginia return, claim that they're not subject to tax, get that money back, and then file a PA return and pay the money to the Commonwealth. So just to point that out, it does become a little bit more complex. So if you see that situation, certainly talk to your site coordinator, and we may have to figure out how to handle some of those issues. Now, one of the unique things about Pennsylvania is that we do actually have a few deductions, not many. They don't really allow many deductions, but they do have a Schedule UE, which is unreimbursed employee expenses. These are not eligible for federal anymore. When federal changed their itemized deduction rules, they got rid of the 2106, the federal unreimbursed employee expenses. However, Pennsylvania has not changed their rules yet. So you may still take unreimbursed expenses for Pennsylvania purposes. We mentioned last time about the educator deduction, up to $250 for federal. Pennsylvania will allow you to take those same expenses on the Pennsylvania return. There is no cap though. It's whatever you actually incurred can be deducted as UE expenses. So where we take a look at these is that there are a couple rules that we have to go through. They have to be ordinary and necessary. They have to be generally accepted in the occupation in which you work. So you have to take a look and make sure that there's a reason why people are taking these expenses. They actually have to be paid while you're performing your employment. They have to be a reasonable amount, not excessive. They have to make sure that you can perform your duties and are directly tied to your employment or other type of occupation. So they have to be reasonable and necessary. They have to be kind of reasonable in amount. They have to be directly tied in. So a couple things that we typically see. Union dues. So if you have an individual who works and pays union dues, typically we may see this coming out of educators. They may have union dues indicated in box 14 of your W-2. Also, if you have individuals who might be in a manufacturing type industry or other type of union due payment, those are deductible. So those are allowed as a Pennsylvania UE expense. Work, uniform, and clothing. Now, here's where it gets a little interesting. A lot of people say, well, I need to buy clothing to go to work. Yes, you do. There are very few occupations where you can show up without clothing on. Now, the issue is, will the clothing actually help you perform your job? If it's something that is specifically related to that occupation, something like safety boots, steel-tipped shoes, perhaps if you're in a server opportunity that you have non-slip orthopedic shoes, if you have scrubs that you need to work at a medical facility, those are considered deductible expenses. If you're a landscaper and you'd like to buy a nice Carhartt jacket because it keeps you warm, that's not a deductible expense. That item can be worn outside. It's not directly related to your work environment. But if you need safety equipment, hard hats, safety goggles, specialized gloves, those are acceptable. If you can wear the items outside in the normal course of everyday wear, traditionally will not be deductible. And again, in years past, this was a fairly clear-cut we'd always kind of say, if you would not want to be caught wearing your work uniform while you're out, it typically means it's deductible. If you have the jumpsuit on, if you're working as a mechanic, you have the coveralls with your name emblazoned on the side, that's traditionally a work uniform. But now you walk around town and you see people in all sorts of state of dress. People that apparently don't get out of their pajamas before they head out to the store. It's apparently acceptable now. Just casually walk around in whatever you feel like. So now we have to change that definition. Now it's not just what do you feel comfortable walking around in. But if it's things like safety vests, day glow, any other type of safety equipment would be considered deductible. But to say I need to wear a nice pair of shoes and a shirt to go to work, that's not deductible. That can be worn anywhere. So we have to see that it's not available for general use. Small tools and supplies typically may have situations where an individual may have to buy certain things that they use within their work environment. It may be circumstances that their employer requires them to have certain things. If they're a repair person, they might have things on their truck, or they might be on a job site. Rather than go back to the company, they may head out to a local hardware store or something along those lines to buy certain supplies and tools. Those are acceptable as well. Now we get into a little bit of a tricky situation. Pennsylvania has really been cracking down on the UE expenses. So this is another area where they really kind of try to make sure, in addition to now looking at that retirement area, that we've been seeing notices for quite some time on the Schedule UE. The Schedule UE, Pennsylvania has been attacking this to say, we need to see proof from your employer that you are not eligible for reimbursement. So just bear in mind, with these costs, if you are eligible for reimbursement and you choose not to be reimbursed, Pennsylvania will not allow you to take a UE expense. So for example, if you are a air conditioner repair person and you have to go out to a local hardware store to get a fitting or some other type of device, and you put it in on the customer's job, and the employer says, well, if you buy it, you should go ahead and give me the receipt, we'll reimburse you for it, and you choose not to do so, you're not allowed to take that part as a UE expense. Likewise, if the employer reimburses you some element of mileage, irrespective of how much it is, you cannot take the mileage reimbursement anymore. So it's kind of unique in that aspect, even though the IRS rate will change year to year, hovering around 56, 54 cents a mile. If they only reimburse you at 18 cents a mile, you don't get to take the difference on your PAUE. So just a couple things to keep in mind. Professional license fees, again, if they're not reimbursed by the employer. So typically we may see these in the medical profession if you have to have professional licensure. Hairstylists, anyone who has to pay fees to the Department of Labor or Department of State would be able to deduct those professional fees. Vehicle expenses, again, we just have to watch on the mileage. Typically employers may say if you run business mileage, submit a report to us, we'll reimburse you. If that's the case and they choose not to do it that way, Pennsylvania will not allow you to deduct it. Likewise, commuting costs do not count. So your mileage from your home to your first job of the day is commuting. That's not a deductible travel expense. Travel between work locations would be deductible. That is business travel. But your first drive of the day is considered commuting. Any parking fees, tolls, transportation, travel expenses while you're away from home overnight, and meals and entertainment. So if you're entertaining clients, if you have customers you take out for meals, if you're buying things, those are deductible at 100%. Federal, for those of you coming next week for the advanced, meals are deductible only at 50% for business expenses, but they're deductible at 100% for PA. I like to think it's because Pennsylvania is the snack capital of the world with how many pretzels, chips, and candy manufacturers we have, but it actually has to do with how they base their tax structure instead. So those would all be considered deductible. However, we do want to make the caution to say we don't want to get into a discussion with clients to say, oh, I bought a $10 pair of shoes, how much is that going to impact my tax return? Well, if you do the math, $10 times 3.07%, not a whole lot. These are generally going to be scenarios where we may see opportunities for people who have union dues, educators who may also qualify for the educator expense for federal. If you have someone who their occupation is pizza delivery, they may not have any direct related expenses for those items. I don't think Pizza Hut requires you to have certain material that you can't wear elsewhere to help deliver pizzas. So again, the Commonwealth is taking a look. They're cracking down a little bit more to make sure that these are actually deductible expenses. Quite honestly, in our profession, we've become quite tired of having to deal with these notices because Pennsylvania will start disallowing those at relatively low levels. So if you take a $50 deduction on your return, Pennsylvania may send you a notice to say, we would like the following pieces of information. We want to see a copy of your receipts. We want a letter from your employer saying you're not eligible for reimbursement. Or alternatively, you can get a signed affidavit saying that you're entitled to take these deductions. Most likely, the issue is, do you do that or do you pay $5? Or have $5 less than a refund? So we just want to be sure that they do qualify. If they do, no problem at all taking them. I don't want to discourage people from taking something that they're eligible to take. Just I don't want us to go through the process of spending a lot of time trying to go through a scenario where it's not going to benefit the client ultimately. So if they have situations, predominantly things like union dues, educator expenses, if they are in a position where they're a sales individual, and I've cautioned people with this as well, that they should probably go back to their employer and be sure that their employment agreement says that they're not eligible for reimbursement. If they are, Pennsylvania's going to disallow it. So just before you get into the position where you say, hey, give me all your miles for the years, give me all your meals and entertainment, let me know everything that you've incurred, we have to just be sure that they're eligible. So just to kind of give you a quick piece of advice on that. All right, for interest income, Pennsylvania interest is typically going to be very similar to PA. However, Pennsylvania does not tax certain items of interest. So the first ones we take a look at, they're not eligible to tax U.S. government interest. So if you have interest coming off of savings bonds, basically box 3 of the 1099 INT is not subject to PA tax. You don't have to make any modification for that. It simply will not carry over from tax layer. PA also will not tax its own interest. So where we may see this is if you are a individual who has municipal bond interest. Federal will not tax municipal bonds, interest from state and local governments. Pennsylvania will not tax its own interest, but it will tax interest from other jurisdictions. So if you have a client who bought Maryland transportation bonds, they would be taxable for PA purposes, but not for federal. So we'd have to make some modifications within tax layer. So any Commonwealth of Pennsylvania interest is not taxable for PA. Any municipalities of PA, so municipal bond interest, if you buy bonds for local school districts, they would not be taxable either for PA. Also, if you have interest from bonds from Guam, Virgin Islands, Puerto Rico, I have yet to see anyone investing in Guam bonds. But if you do see it, the interest is not taxable for PA. You do see it, slyly take a picture of that. We'd love to see what that actually looks like in terms of a Guam bond, but that would be not taxable for PA. So within tax layer, and we'll kind of see this a little bit more as we get into the program itself, there's actually in the interest screen an opportunity for you to edit the button as well. So basically, you can add and edit the interest to make sure we have the appropriate amount going to Pennsylvania. Again, in most cases, it's probably going to come right from federal. There's only the main issues we need to adjust is if you have municipal bond interest not taxable for federal purposes, and we need to take a look to see how much of that would be taxable for PA. So again, PA will tax any municipal bond interest that's not from PA or its Commonwealths or Guam or Virgin Islands. But other than that, pretty much all taxable. All right, so the dividends will pretty much carry over. The one unique aspect about dividends is that Pennsylvania will treat capital gain distributions differently than federal will. If you have capital gain distributions from a investment account, those will be reported on our Schedule D and flow to the 1040. If you don't have any other capital gain transactions, it just simply comes up without having a Schedule D attached. For PA purposes, however, they will move those capital gain distributions up to dividend income. So they just are reported separately. So if you're taking a look at the returns, making sure you self-review and have all the information, the dividends may be different for federal than they are for PA. And the nice little trick for PA is they move those cap gain distributions out because otherwise they may help offset capital losses if they stayed in the capital gain section. They move them to dividends because they treat them as dividend income. So they will not be eligible to offset any capital losses. These first few categories, wages, interest, dividends, we won't see any losses. So you don't have to worry about offsetting between spouses. Capital gains, if you do take the advanced certification, you enter capital gains. Just bear in mind, if you have more losses than you have gains, you can take part of it for federal. You cannot take it for PA. There is no carryover or anything else. If one spouse has gains and the other has losses, they will not be able to offset each other either. They can for federal, but not for PA. So Pennsylvania just has some unique things. So if you think you're pretty good at math and you add up positive numbers and you're used to subtracting negative numbers, forget about subtracting negative numbers for PA. They don't take negatives into account. They're only good at addition, not so much subtraction. So the PA 40 may look a little unique if you haven't seen one before. More so if you have an advanced issue where you may have a couple things, mainly coming of losses from cap gains. But we talked about $33 of income. That's what you kind of need to be able to file a return. We talked about all the ways PA will kind of add positive things in for income. They don't give you a whole lot of deduction. However, we have a fairly nice tax credit that will be applicable to a majority of individuals within VITA, particularly seniors and others that may qualify for tax forgiveness. So even though that you may have a senior who comes in and their retirement income is not taxable, their Social Security is not taxable, they get a 1099 DIV and they show $63 of dividend income. So you'd say, oh, okay, well, how do I break the news? We have to write a $2 check to PA. Because the good news, if you have a $1 payment, they don't need it. $2, they want it. But they may qualify for tax forgiveness. And this is a Pennsylvania Schedule SP. So this allows certain taxpayers to actually reduce all or part of their tax liability for PA. So a couple things we're going to take a look at. First of all, we have to go in and tell the system that they're eligible for tax forgiveness, which is one of the just little downsides of this program. But if you go into the credits and you tell them they're eligible for tax forgiveness, it will go through the calculation for you. It's typically going to base it off of their taxable income, but there are a couple additions that will have to happen. It's going to add back things like alimony, their non-taxable interest, get added back for purposes of determining income for tax forgiveness. Inheritance is never taxable on federal and state purposes, but you have to add any inheritance in calculation for economic gain. So if they have an inheritance, that gets added back in. Non-taxable educational assistance. Usually we don't really see this in VITA, but if they're getting tax-free scholarships, that would be added back for that individual, not for dependents, just for the individual. If they have excluded gain from a principal residence, this is kind of an area that may actually crop up. If you have people, and I've often seen this, is you have an individual who may be moving from their primary residence into, say, a retirement facility, and they've been accustomed to taking advantage of the PA tax forgiveness for many years. And all of a sudden that they've had this gain on their home, they don't have to worry about it because PA won't tax it, federal won't tax it, but you need to add that amount of gain back in for tax forgiveness. So if they had an $80,000 excluded gain on their home, that comes into our tax forgiveness calculation. And $80,000 of income will put you out of tax forgiveness. So they may have 1 year that they actually have to pay tax to PA. So just bear in mind, some of these will automatically calculate. Some you may need to go through and just verify. The alimony will come over automatically. The inheritance you will need to ask about. The gain on the home, depending on how you enter that for purposes of federal purpose, may have to be entered separately for PA. Typically, you don't need to enter the exclusion for home sale, but you do need to inquire about it for PA. So if it is an amount, we do need to add that back in. Now, one of the other unique aspects is that it's going to be based off your income and the number of dependents that you have. The one caution that we have is that oftentimes dependents look like they can qualify for tax forgiveness. So if you have an individual who files a return, they have a part-time job, and they only have $4,000 of income, and you go into TaxSlayer and by nature, you just automatically check everyone's eligible for the tax forgiveness. Bear in mind that if you're dependent on someone else's return, that taxpayer also has to qualify for tax forgiveness in order for you to qualify. So what will often happen is you'll have to file a return for a dependent child who may have a part-time job. Fortunately, they typically don't owe any tax because most employers know how to withhold 3.07% of their taxable wages. But don't try and get them into tax forgiveness and say, I'll get you $14 back for PA. They only qualify if their parents also qualify for tax forgiveness. So again, we may only see this typically if we're preparing the student return with the parent is the best situation. That way you can see what happens. If you have a student who comes in, if you're at a site near a college campus and they're trying to get their taxes done and you're giving them tax forgiveness, you may want to double check to see if their parents are also eligible for tax forgiveness. If the parents are not eligible, then the student can't take it either. Okay, so a couple other issues we just want to kind of mention here about PA. We could go on for days about Pennsylvania taxes. I used to do a 3-hour seminar on Pennsylvania personal income tax, so we'll kind of boil it down a little bit to just some more relevant issues. But a couple other things that we take a look at. We have said that retirement income is not taxable. Distributions from retirement accounts are not taxable for PA purposes unless they're early or unless they're not really retirement distributions. And this situation arises if we have individuals who invested in annuities. So an annuity, while it's being reported to you on a Form 1099-R, for Pennsylvania purposes is not a retirement account. A retirement account for Pennsylvania purposes is anything that you actually put into or your employer set aside for you for purposes of retirement. An annuity contract is an investment vehicle under Pennsylvania rule. So one of the things we take a look at, whether it's a purchased annuity that you purchase through an insurance company or mutual fund company, or a gift annuity that you purchase through a nonprofit or retirement community, any taxable amount for federal purposes will also be taxable for PA purposes, treated as interest income. And one of the things we want to take a look at is 7D. So if you have a code D in box 7 of your 1099-R, what we take a look at is that would be the amount that gets reported to PA. Again, there's a little technique we need to do in TaxSlayer to get it to work, but those would be subject to tax for PA purposes. The amount that's shown as taxable income on a distribution from an annuity would be taxable for PA. We don't need to do any additional calculations. That's actually coming from the annuity provider. So they've already calculated how much of that distribution is return of capital and how much of that's going to be earnings off the account. So if we just see a D in box 7, don't get all confused that there's no, there's no 7D on the back. Those are two separate numbers. 7 would be a normal distribution. D is indicating that it's coming from an annuitized product. So if it's a D, then there's actually a spot on the PA interest form to include distributions from insurance companies, annuities, and charitable gift annuities. So that will be taxable. If someone asks, is this new? The answer is no, it's not new. So we've been preparing returns for a while that we haven't done it. Option of what you want to do with those returns, but if you see a 7D, it is taxable for PA purposes. One of the other unique aspects that we have with PA is a concept called use tax. Use tax is a corollary to sales tax. So for those of you who buy things, you may be aware there are certain elements of items that are subject to PA sales tax. And that's a fun little area if you ever want to go through and determine what is and what is not subject to sales tax. So coats are not subject to sales tax, but furs are. If you go to the grocery store, most of the food that you buy is not subject to sales tax unless it's ready for you to consume, then it is subject to sales tax. Certain items like health items are not subject to sales tax. Sports equipment can be, depending on the type of equipment. But generally, your retailer will tell you what's taxable and what's not taxable. What's kind of unique is that we actually have a jurisdiction that's not on the reciprocal list, that's not too far away from here, even closer to areas like suburban Philadelphia, which is very easy to go buy things in, especially large items, appliances, jewelry, things that travel well, where they don't charge sales tax. Now, Pennsylvania will say, if you buy items and you don't pay sales tax on them and they're used and consumed here in PA, you as a consumer owe use tax. So if you bought an item and say you went to Delaware and you came back and you said, while I'm down here, I'll pick up that big flat screen TV I had my eye on. So it's $2,000. I just saved myself 6% on a $2,000 purchase. technically, Pennsylvania would like you to pay the use tax that you owe to the Commonwealth. Same thing if you buy things online from a retailer that does not charge sales tax to PA. We just had a recent Supreme Court decision that may change that a bit of how taxability will happen. But in years past, when Amazon first started selling to PA, they did not charge sales tax because they did not have substantial presence. So for people who went ahead and bought a lot of things online, they never paid sales tax. PA is going to request that you submit that. What's unique about this is a voluntary compliance. They have the question on the return, do you have any use tax that you would like to report? You have to answer the question, but they can't force you to give them the right answer. So the question is, do you have any use tax that you would like to report to Pennsylvania? In most cases, that answer is most likely, no, I do not have any use tax I would like to report to PA. 0 is a valid answer because you're going to ask the client, and typically you're going to get a blank response. If you just ask them, oh, by the way, I have to answer this question so I can actually file the return. Do you have any use tax you would like to report to PA? And they have no idea what you're talking about. So rather than getting a big discussion to say what it is, and then they're starting to go through their mind and say, well, I had a weekend in Rehoboth, and I bought some pizza, got a couple things on the boardwalk. How much would that typically be? Well, we have a couple options. One of the unique options is we have an opportunity for PA that they will automatically calculate what they think is an acceptable use tax based on your income. So we have a little bit of information here at the bottom of your slide. Effectively, if you have $15,000 less of income, they will say send us $6 and we'll just call it even. If you're between $15,000 and $30,000, it's $12. If you're between 30 and 50, you're at 17. So if you have individuals that say, yes, I like to purchase a lot of my items without paying PA sales tax, I feel so guilty, I would like to make sure that we can help reduce our deficit here at the Commonwealth. Tell me which number I should pick and I will gladly pay it. So you may pick one of these options. Again, 0 is a valid option. You can say, let me go ahead and base it off the income. Or, as I've had in the past, I've had clients come in with a detailed listing of everything they bought without paying sales tax. That's fine if they bring it to you. I'm not going to suggest we waste our time and pour through receipts and determine what they bought out of state where they did not pay appropriate sales tax. Because the sales tax issue is kind of unique. If, say you went to a state and you paid 4% sales tax, you brought the item back here to PA, you'd owe the difference, 2%. If you buy anything in New Jersey, New York, or Washington, D.C., you paid more sales tax than what they have here in PA. You don't need to worry about it. The main issue we pretty much have is people who go down to Delaware. If you've ever been around a waterfront, you know most boats are registered in Delaware, even though they've never seen any amount of water in Delaware. It's kind of a tax-saving opportunity. Most times we don't need to worry about people in VITA buying yachts and not paying sales tax on it or their aircraft. But they can answer the question on sales tax. If they have use tax opportunity, they're more than welcome to answer the question. Believe the majority of our clients are zeros. I think on occasion we have had people disclose sales tax. Has anyone here ever had a client bring in their use tax? Okay, all right. So on occasion it may happen, but traditionally I think most of us have answered 0 that they'd like to report to PA. Okay, again, it's voluntary compliance. They would like you to submit, but there's no requirement for you to do so. There's no penalty for not filing use tax at this point in time. Just a couple things we want to point out about PA here yet. Our school tax code, so we do need to know what school district the individuals lived in for PA purposes, and when we get to local return, we drill down even further to their municipality, but we've just provided a list of the school district codes for you here on the next 2 slides, also available within your PA section of your volunteer guide. Most times people may have a good idea of what school district they live in. They may not know if they live in a township, borough, or where exactly the borders are, particularly if they're renting. Most people know what school district they're in. We do have a municipal lookup service that we can determine based on their address exactly where they live. Now, one of the other things that we take a look at, one of the other reasons we sometimes have people come in to get their taxes filed is this whole PA property tax rent rebate situation. So seniors, again, may qualify for tax forgiveness. We have to, in tax layer, elect that they're eligible for tax forgiveness, but they may also get this property tax rent rebate opportunity, an opportunity within PA that is restricted for certain individuals. It's going to be seniors age 65 or older, widows who are age 50 or older, and people with disabilities who are age 18 or older. So if you fall into one of those categories, a senior 65 or older, widow 50 or older, or disability basically being a 18 or older, you can qualify for tax forgiveness. These income limits are a little bit higher for property owners, actually about twice as high, a little more than twice as high for property owners. These are kind of our kind of best guesses here where they're going to be. A little over $36,000 for homeowners to be able to take full advantage of the credit. Just a little under $16,000 for renters. Once your income's above that level, you no longer qualify. And what do we mean by income? Well, it's going to effectively be some taxable income, but we're also going to add back 50% of your Social Security and your railroad retirement benefits. So 50% of your Social Security is going to be excluded, 50% will be in. So that'll be part of the calculation. For the majority of time, the PA 1000 will be automatically calculated by TaxSlayer with a couple adjustments. So a couple of the things that we talked about that were not eligible for SP: alimony, inheritances, spousal support, and gain from the personal residence have to be added back for purposes of the rent rebate claim as well. So if we had it for tax forgiveness, we also have to add it back for the PA property tax rent rebate. Another little wrinkle we've run into in recent years has been exchanges of insurance policies, not taxable for or for federal purposes. It can sometimes be a code W. PA will treat those as income for purposes of the rent rebate credit. So if you have a 1099-R, the PA may be excluding some income based on those activities. Situation we ran into, again, kind of the fun summer stuff that Steve and I get to take a look at on occasion, where we wonder what happened with some of these issues. So there may be a few little interesting areas that may pop up, but for the most part, the PA 1000 will be fairly straightforward. A couple things we take a look at is the benefit amount is $650. That would be our maximum standard rebate. They do have the opportunity to effectively supersize their rebate. Again, that's coming from the Commonwealth. That's not our calculation. But if they have a situation where their property tax would be basically more than 15% of their income, and their income's less than $30,000, they can actually boost that maximum rebate by another 50%. So the state may calculate it. So if you prepared a return for someone before, and they said, I don't know what you did. You gave me a form that said I'd get $650 back, but I got a lot more. What should I do with that money? You know, who do I need to tell? Because I don't want to go to jail. Well, fortunately, they're not going to go to jail, and neither will you. But it's a whole concept that the state will go ahead, and if they see that calculation, that if their income is less than $50,000 or $30,000 and the property tax is more than 15% of their income, they will automatically adjust that credit. So it works out fairly nicely. Now, the downside is that when we take a look at the credit, it kind of phases out a little bit quicker here. When we take a look at homeowners, you can get your maximum rebate basically if you're under $8,000 of income. It will phase out completely once you're over about that $36,000 figure. Effectively, it gets up to about $35,000 when you look at the instructions. But when they go through the calculation, it ends up being a little bit closer to about 36. Once you're over that, you do not get the credit. For renters, it's a much lower threshold. Basically, you have to have income a little less than about $15,000, $16,000 to qualify. So the system will automatically calculate this based on your amount of income that you have. Again, what we need to add back in are certain things that the TaxSlayer may not know, things like inheritance and gain on the sale of a personal residence. Those need to be added back. Now, in terms of how we complete the return, there are a couple things we want to take a look at. So income attachments, what we basically need to attach to the PA 1000 are a couple things. If they lived in PA for the entire year, we do not need to give them a copy of the Social Security statement. Pennsylvania already has a copy of that. Typically what we'll do is we'll give copies of the 1099. That would show anything we have for purposes of pension, retirement distributions, annuities, that type of things. The 1099s go. This is one of the reasons how PA will pick up on whether or not there's some unique codes. Federal returns, typically we've also, depending on your site, have attached page 1, which will be kind of weird because now page 1 doesn't do anything for you. It's now going to be page 2 of the 1040, can go along with the copy of the PA 1000. Now, in order to claim the credit, we also have to prove that some sort of property tax was paid. So if you're a homeowner, you need to attach proof of property tax payment. That can either be a copy of the receipted tax bill. So if you've gone to your local office and you walked in, so your local municipality, which will welcome you to walk in with a check, and they'll stamp your receipt as paid, or you can go back later and request a receipted copy. They will actually give you a copy of your bill showing that it has been paid. That will be sufficient. If you don't have a receipted copy from the taxpayer office, you may actually show copies of your canceled checks and a copy of your real estate tax bill. The way banks work now, it's sometimes easier to go down to the taxpayer office and get a receipted copy than requesting copies of your electronic statements and get a copy of the check. Either way can work. If you are using a mortgage service, if you're actually having escrowed property taxes, your Form 1098, if it shows property taxes paid, will be sufficient as well. So you don't need a receipted copy of the tax bill if you have a 1098. That'll show the amount of real estate taxes paid. So that can work as well. So for a renter, you need a couple other things. So the renter is going to need a PA rent certificate completed by the landlord. So your landlord has to fill out a form that basically says you're a renter and that you meet the qualifications. So that signed form needs to be part of the rebate claim. Oftentimes, we may have individuals who come in that they don't have all their documents together. We can prepare as much of that rebate claim as necessary and let them know what else they need to attach. Oftentimes, we may have the people who come back in after they have all the documents to make sure they have everything together, and that is perfectly acceptable as well. But we can complete as much of the PA 1000 rent rebate as necessary. So a couple other unique aspects that only apply to first-time filers. Again, we're looking at a couple situations that we either need proof of age, proof of kind of widow status, or disability. So for first-time filers only, you need to have some documentation. Once you're in the system, you can go ahead and continue to file, and you don't need to go through the first-time filer. What's unique about this is that in order to get it for the first time when you turn 65, the government wants to see copies of the documents to show how old you are. The first document they ask for is your birth certificate. If anyone's taken a look at a birth certificate, in big letters, it says, do not photocopy. Issued by the Commonwealth of Pennsylvania, who's now asked for a copy of the document back again that they told you not to photocopy. Little ironic. But, so a copy of the birth certificate, the one time I think you're allowed to copy the birth certificate, is to send it back to the people that gave it to you in the first place. Hospital birth record. So if you don't have a birth certificate and you have that little slip from the hospital that may be in a scrapbook somewhere that says, congratulations, here's your kid. The hospital birth record would count as well. So that just basically gives record in case someone doesn't have a birth certificate. They changed the rules a little bit. Obviously, if you try to get a passport in the past couple of years, some of you may have had to go back to request a new birth certificate with the raised seal. If you haven't done that yet, you have the birth record, which I still have a copy of. I guess it was in my scrapbook somewhere. That would count. Driver's license would count. Passports, PAID card, a Medicaid card, PACE or PACENet card, anything that shows who you are and your birth date would prove your age. So the first time filing, if you're 65 or older, people who may have just moved here to PA, we do need to go through and show proof of age. Widow or widower, we still need to go through the age thing as above. So again, when you photocopy your birth certificate, you also need to attach a copy of the death certificate. So that, ironically, that also says that you shouldn't be photocopying that either, but you can send photocopies of all those documents. Usually you can get the short certificates, but if you send proof of death of your spouse as well, that'll prove your age and also put you in that widow category. For anyone permanently disabled, you would need to get a letter from Social Security if you have an SSI award. So if you have a Social Security disability, you take your Social Security award letter. If you have a VA disability, you will provide the VA letter. And if you didn't have your disability from SSI or the VA, you can actually get a physician to sign a statement. that will disclose the nature of your disability. And that's actually a PA 1000 PS, which stands for physician statement, which is kind of a unique way of how we've done that. All right. So those are the issues we take a look at. If you have a medical condition, again, you need either the SSI award letter, the VA award letter, or a signed statement from the physician, just to be attached with your initial filing. After that, you'll be in the system and you don't need to do it again. All right, so that kind of takes us through a whirlwind here of Pennsylvania issues. Again, the majority of which I think will be covered within TaxSlayer. The one issue we may want to take a look at is Schedule SP that you have to elect to participate in. There may be a few little wrinkles when it comes to some early withdrawal from retirement accounts, but I think we'll go ahead and take some questions here.
Yep.
All right.